Pivoting to recover, what will M&A look like post-COVID-19? This webinar today is brought to you by the European American Chamber of Commerce, where Europeans and Americans connect to do business. I'm Todd Schwartz, Executive Director of the Cincinnati chapter of the EACC, and I'm being your host today. Catherine, I didn't notice the numbers, but I think we have over 100 folks registered for today's event from across Europe and the United States. So I'm confident we're going to have a very vibrant and transatlantic international discussion. One quick disclaimer. Please note that all comments and opinions represented by our speakers today are their own, and they do not necessarily represent the views of the European American Chamber of Commerce or its members. And now, let me introduce Catherine Pruitt. She is my colleague and counterpart, the Executive Director of the European American Chamber of Commerce in Paris. And I'll ask her to introduce our topic and our speakers. Thanks.
Thanks, Todd. Thanks to you and also to Yvonne Bendiger-Rothschild, Director of EACC New York, for assuring that this panel benefits from the expertise of EACC members on both sides of the Atlantic, for what promises to be a dynamic exchange on merger and acquisitions post-COVID-19. So you've seen the biographies, so just allow me to extend a warm welcome to our panelists. We have Paul Averazano, Managing Director and Global Practice Leader, Global Transaction Advisory at Alvarez & Marsal. Alexander Crosswaite, Partner at Latham & Watkins, Paris, who specializes in complex mergers and acquisitions and private equity transactions. Justin McGrory, Director of U.S. Mergers and Acquisitions for HSBC, and Bob Bragan, Managing Director, Alvarez & Marsal, Munich, and co-director of their European Private Equity Performance Improvement Group. We also have the honor of having this panel moderated by Miriam Gottfried, private equity reporter at the Wall Street Journal. Thank you, Miriam. I leave it over to you.
Thank you very much, Catherine, and welcome to everyone. It's a pleasure to be here, and I'm just going to start off with the questions. My first question for you panelists is, what are the phases of recovery for M&A in Europe, and where would you say we are now? And maybe you can also add another dimension of, cross-border M&A. Where are we for cross-border M&A?
So first of all, thank you for having me here today. I appreciate it. Very much looking forward to the discussion, and happy to be here with the rest of the panelists. I think your first part of your question is where we are today relative to the stages of M&A. We could say in Europe, but it's really applicable to, I think, what we're seeing around the world. The way I look at M&A is kind of two parts to it. There's financial sponsor private equity M&A, which is where I spend a lot of my time. But then there's also corporate or what I'll call strategic M&A. And you really have to bifurcate those two to look at where they are in the cycle. If I start with the corporate or strategic M&A, I think what we're seeing is, twofold. There were industries, and it's very industry specific, that were going through transformation well prior to COVID and the pandemic. And industries such as, oil and gas, technology, healthcare, financial services, particularly insurance, automotive, consumer and retail. These were industries that were dealing with a lot of technological disruption. You saw, companies that were either buying other companies to get ahead of a technological matter or issue, or companies selling and divesting certain businesses where they knew they couldn't compete, or they're going to get disrupted by technology, for example. Well, much of that has been accelerated by the pandemic. So on the corporate transactional side, I think we're going to see a lot more, divestiture activity. So people focus on their core businesses and also maybe some acquisition activity to get in or get new technology that they need to compete for the future. On the private equity side, I would say it's been a little different. The first and foremost, when the pandemic hit, most of our private equity clients were focused on, cash and liquidity and maintaining what they had in their portfolio. So, we were calling it the pivot to cash. And that's what everyone, that we work with and clients at Alvarez & Marsal around the world were focused on, was maintaining, protecting, and securing their existing portfolio. But very quickly, after I'll say a few weeks of that, I think from lessons learned during the global financial crisis, many of our clients because there was so much dry powder and liquidity in the system, whether it be private equity, sovereign wealth, family office. The folks went out and started going on offense and looking for transactional opportunities to take advantage of the COVID environment from an M&A perspective. And that's still going on today. It's slowly starting to return. I think what we're seeing is, investors that are distressed or special situation investors are, arguably going to be the first off the sidelines because they thrive in a little bit more of a chaotic or uncertain or volatile environment. And then I think you're slowly starting to see, and we're seeing that now in July, a return to a more normalized M&A environment in certain industries, given the amount of capital that needs to be deployed within the private equity or financial sponsor sector. So, from an A&M perspective globally, I think that's what we're seeing and starting to see as we move, into July right now.
Right. Thanks, Paul. And just to follow on, obviously M&A activity has been curtailed or dampened here drastically globally, maybe more so in the U.S. over the past 4 months since the pandemic hit. The path to normal activity, I think, is a function of just getting clarity on a number of issues, and we're under a broad umbrella here of uncertainty. Uncertainty, obviously, in the length of the pandemic, especially in the United States, as we see some states that have to date not been as affected, seeing their cases spike up. Number two, just a general understanding, especially in industries that have been harder hit, what the future earnings will be. It'll be harder in some industries. Paul said it's very industry specific. So more clarity on the future earnings and profitability. I think just a better understanding of how M&A is going to get done under the travel restrictions we have and just the logistics around M&A. And what I've seen is processes that have been on hold and processes that were being considered but hadn't launched are now really targeting a post-Labor Day launch with the hopes that some of these travel restrictions, especially cross-Atlantic, will be lifted kind of towards the latter end of the stages of the sale process. And then the fourth bucket of uncertainty that obviously will need to, and more important for some industries than others, is obviously the U.S. presidential election at the end of this year.
Miriam, it's Bob Rajan here. I'd just like to add a couple of comments to what both Paul and Justin said. I think I agree with everything they've said, and what Paul said, applies globally with regards to what we're seeing. I think the other thing to add also from some of the work that I do is not only are companies looking to acquire, but they're looking to acquire companies that can help them enable and transform their business model. Because now, as everyone said, we're in a new normal now, or sorry, we don't know what the new normal is, but there will be something as a new normal. So, retail is obviously the easy example to talk about there, is that, there's just not enough people going out to the stores now, depending on whichever jurisdiction you're in. It's a pretty consistent trend around the world. And also, so that whole thing, I've been speaking to a lot of retailers who have been looking obviously at, what enablers from a technological perspective could they acquire to help them leapfrog their business into what may be something new. So I think that's quite important. And I think in that whole context of people with remote working now and using your iPhones more than you probably ever thought you were going to use in the past, those things are all sort of, I don't think we're there yet, but that's slowly moving with regards to the phases of M&A recovery that we currently are experiencing all over the world.
Yeah, and maybe to add the lawyer's perspective to this, European lawyer. So during the 3 months of lockdown we had in France from mid-March, the good thing is we managed to close most of our deals, all the many deals we signed in the first quarter. We managed because in most situations in Europe, the deals are certain funds and do not have MAC clauses, at least all the PE deals and a large portion of the strategic deals. So we were able to actually make the closings happen, and from a logistics point of view, it was a big shift for everyone because we tend to still use paper a lot, and we did everything paperless. And I think that's a trend which is going to stay. People like signing remotely. It works. It was a test, and it was a successful one. We did see a few transactions collapse, pulling the MAC trigger when there was one, and lawyers agonizing over the exclusions and whether pandemics are included or implicitly, explicitly, and so that was an interesting time, and clearly all the auctions were put off, but since about mid-June they're clearly back. Either auctions are actually reopening, or the people know what targets are on for sale, and we see a lot of preemptive move. We're currently acting for a number of sponsors who are preemptively trying to avoid the target going on auction, and putting in pretty strong bids, because as I think was mentioned by Paul, there's massive levels of dry powder to deploy, and a number of PE houses think this is the right time, and that those who are the quickest to move will be successful. So we're seeing that, and to a certain extent, the syndication market for leverage finances has reopened, perhaps a bit more expensive than it was, but that's also helping PE sponsors re-enter the market. Although we're still, in secondary deals, we have a number of debt financing which is portable, so we're also using that. We hadn't done it for some time because the conditions are always getting better, so there's no point to roll over the previous financing, but that's an interesting feature, that portability has its merits in this kind of circumstance, using those. And the question I have is the rebound or catch up of what hasn't happened for the last 3 months, or is it going to stay? I mean, I think it's my sense is that it's definitive, right? We're going back to where we were before the crisis, but it will be, we'll know more on that, I think, in September after the summer break in Europe.
Thank you, Alex. Maybe, a little bit related to something that Alex just said, could you talk, panelists, about the financing market and how easy it has been for the deals that you've seen getting done to get financing, maybe particularly from the private equity side, where that is a key factor in the ability to get deals done? Has financing been easy to come by, and what are the primary sources of financing for the deals that you've seen happening?
Sure, I could start with that if you want. And by the way, you had your prior question, Miriam. You had also at the end of that asked about cross-border deal activity, which I don't think any of us addressed. So let's just remember to go back to that, because we do have some interesting observations there. When it comes to financing, it's interesting. I've been doing this transaction services for, advisory for M&A for almost 25 years. And when you go back and look at the global financial crisis, which was first and foremost a financial crisis with the banks, lending went to zero. And when you lose the L, there's not too many LBOs happening. So during the 2008, 2009 time period, M&A activity really dropped and went close to zero as a result of that. Today, it's very different. Granted, we've only been in the pandemic for a few months, around the world, but this is first and foremost a health crisis, which is causing an economic crisis. The banks I've seen, the commercial lending institutions have been, they're a much better strength going into this pandemic than they were in 08 and 09. And while I say it's not easy to get deals financed, and we're seeing clients over-equitize deals in order to transact, financing is there for good companies. And if it's not commercial financing, something that we have in the environment today that we didn't have 10 years ago are alternative financing sources, private debt, private credit funds that are, rushing in to fill the void. So I think it's also creating a level of competition amongst financing sources to finance good companies. So I think financing is there for strong businesses, although we are seeing clients still over-equitize deals to just remove that level of uncertainty. That's what we're seeing, at least at A&M, from where I sit.
No, thanks, Paul. And I agree. I think that private equity has a luxury of being able to be flexible and creative here, and act quickly, as more of the strategic acquirers have to focus on their own house and making sure that everything is okay with their operations before maybe, so they might be a step behind in looking at some of the opportunities out there. But you have seen more interest in, and obviously private equity plays heavily in this, in pipes, so private investments and public equities, and also just, as you mentioned, Paul, over equitizing deals with the hope that, to the extent that you're not able to get the leverage that you might have been able to get in prior times, you are comfortable enough with the business that you're buying that perhaps next year you can relever that business, and you take some money off the table that way.
I agree, Justin. I think the one thing, I would agree with all that. I've seen here a couple of.
I think you went back on mute there for a second, Bob.
All right, can you hear me? Yep. Okay, I saw someone
loud and clear.
So, anyways, so I think there's still a lot of dry powder out there. So the over equitization, I've seen that as well in a couple of deals. Almost, and I've also seen a couple of private equity firms race to the banks as quickly as they could when the pandemic started. So they were, the thought was first come, first serve, and if I get in there early, I can get something done with the banks. But I've seen the banks be quite, so far, cooperative there. I think the one player, not related to private equity or sort of corporate, but the government, we saw this in 2008 with the bailouts, and we're seeing it again. And we're seeing the governments come with, at least in Europe here, we're seeing a couple of different type of stability funds being launched, and they're trying to be. I mean, that's a tough role to play because not everyone will be a winner, right? So, but I was on the phone today with some government representatives about this exact topic, and they're cooperative. They're trying to help out. Once again, what they have. Even the government has similar type of factors that they look into as a normal lender. What's my exit? And what does it look like? And when will I get my money back? Now, they may have different hurdle rates than some of the other people, but they're going through the same exercise. And so once again, if there's a good business, they will make it through, not a problem. If there's a subpar business, I think there will be chances to get that assistance. But the business that were suffering before the crisis have been accelerated through, and I don't think they have a chance to get any type of new financing that's out there.
I can confirm the trends which have been described here. I mean, the over-equitization, we're trying to cope with that, including through clauses in shareholders' agreements, so that whereby the lead sponsor has the right to relever in the next recap in the next 18 months, and we get advance permission to do that, to get the leverage where back to where it should be. We're using, I think this was mentioned by Paul, we're using the direct lenders as an alternative. But I think the fact that the capital markets have reopened, the leverage financing is following up. It's clearly reopening here. Over the last 3 weeks, we're getting the deals financed. As it was mentioned, this is for good companies, good LBO targets. For the market, I think there was also mention of the refinancing which occurred during the crisis. I mean, in France, it's been massive around the state guaranteed loans. Everybody's been taking them up, even people who didn't really need them, just because first we rushed to draw the revolvers, and once that was done, the the state-backed loans were available, and there was uncertainty at first whether PE portfolio companies could use them. Then it got clarified that they could, so we managed to draw a number of those and get them at the right place in the existing financing structures. So they've been helpful, and they've been but they've taken a lot of time of the both the managements and the bandwidth of the sponsors themselves. But I think that was the past now. I mean, obviously they have to be paid back at some point, but the time-consuming aspect of it is behind us, and both managements and obviously deal teams at sponsors are focusing on new business now, which I think is promising for the upcoming quarter.
I'm going to pose one of the questions from the attendees that's been submitted that's related to this discussion. Have you seen a change in the terms attached with the financing over the last several months?
Maybe I'll start there. On a couple I've been involved in, if the question is, are we heading back into Cov Light territory? If that's what it's addressing, yes. At least the ones I've seen are heading more into that territory. And whenever there's a crisis, it's quite funny from the year 2000 with Enron, and then 2008 with Lehman Brothers and everything. You would think that we all learned something from that, but it takes a little bit of while after, and then we sort of revert back to old habits. And so, at least in a couple of deals I've seen, I would deem them as Cov Light structures that have been put in. And on one hand, I think that's good, because that's, no one knows exactly what's going to happen. And so that's giving the company and management, and me as an operator, giving the flexibility to be able to have a little bit of wiggle room to be able to get there. But I think we need to all make sure we go in with our eyes open on that this doesn't cause a financial pandemic, so to speak, that we have more and more companies that begin to fail and not meet their covenants.
I can confirm the trend. I mean, it's still very much Cov Light. I mean, the borrowers seem to be still pretty strong-handed on negotiating terms, and actually we're seeing the same on M&A. I mean, the sellers are still we're including COVID clauses throughout the documents, but they tend to turn in the favor of the sellers much more than the buyers, at least, again, more on the good assets. But the COVID, the potential return of the pandemic is always a carve out in favor of the seller. That it's a carve out to the interim covenants, it's carved out from any MAC clause, and it's a risk of the buyer, which I think is also a sign of recovery and people wanting to do deals.
I was those are great points that Bob and Alexander raised. My response was going to be, changes in terms. I was going to say, what terms? There's been a lot of covenant light loans, and Alexander raised a great point, because, for the good companies that are out there that either haven't been materially impacted negatively by COVID or are actually benefiting from the pandemic environment, those businesses, sellers have not adjusted their expectations as far as valuation multiples. I'm asking a lot of our clients, whether they're, the expectation is that in this environment, intuitively, you would think valuations would come down given what's happened. But what's really happening is there's scarcity of good companies coming to market. So if you don't have to sell a business today, you're not. So you're only selling if it's a troubled situation, or what's literally happening is it's a good company, and because there's scarcity, there's people needing to deploy capital, and it's bidding those assets up. So it's still very much of a seller's market. We haven't seen a decrease in valuations really much at all. And as a result of that, the financing terms are still, pretty strong to where they've been as far as a covenant light perspective, even pre-pandemic.
Paul, maybe you want to answer this another question that's sort of related to the point you just made, which is, how are company valuations being approached in these markets? Are people taking at the average of the 2019 EBITDA and 2020, or just skipping ahead to 2022? How are people thinking about that?
It's a very difficult situation, and you see the term, EBITDAC being thrown out. So what I would say is, but you need to be careful here. You need to bifurcate this question between valuation of existing portfolios, right? Which is what I'm not talking about here. Okay, that's a different exercise. If you look at the valuation of new transactions, okay, buy and sell side. So we're talking about new transactions here. The struggle becomes, how do you put a value on those businesses? You can't simply throw out 2020 or the pandemic period and say, this doesn't count. Let's just look at 2019, because you don't know if the business is going to return to pre-COVID levels post-COVID. And therein lies the struggle. And when you look at, they're defining it as EBITDAC, right? And that C is COVID. When you talk, and Bob can comment on this, when I talk to my operating partners, it seems like it's easy for companies to identify the incremental or excess costs associated with the COVID environment. But the challenge becomes the revenue impact. How do you, if they're non-contractual revenue items, how do you put a value on what the revenue, and therefore, let's say the EBITDA component associated with that, what that's going to be? And there is the challenge, and there's been no consistent approach in doing that yet. And what that does is that raises a lot of risk factors from a buyer's perspective, because, what's being put in or added back in the C in EBITDAC, right? Again, we could isolate the costs, but it's the revenue side of things. And, if people are putting in the opportunity, or the lost revenues, some calculation or some estimate, or lost EBITDA associated with COVID, how do you validate that? And that's the real challenge. So on new deals going forward, there's a great amount of risk around the C and EBITDAC from a fraudulent perspective, or even if it's not fraud, it's just consistency or lack thereof. If you give a seller credit for that C, whatever that is, someday if you're a financial buyer and you go to exit, are you going to get credit from that down the road someday? Are your financing sources going to let you adjust for that as well in the financing documents? There hasn't been a new normal, set for that yet. I think someone will probably, I'm sure the industry will come with a generally accepted precedent that then will be applied across deals, but I haven't seen that happen yet in any other countries around the world. And when I talk to our clients, that's a struggle.
Yeah, I'd agree. I think it goes back to the industry that the business participates in. So just from a value expectation standpoint, some industries obviously you're not going to be able to really deliver clear guidance on what 2021 will be. But those businesses that are in the market that maybe haven't been as impacted as others by COVID, can look to 2019. I would say that in a sale process, you might still lose some strategic interest, going back to what I said before, because they're more focused in-house. But broadly, you will see M&A for these industries that have suffered disproportionately, but it won't be through your traditional two-stage auctions. It will be all stock deals where both companies have really decided to combine to survive, and been maybe affected at the same level, and their stock prices and their operations have been similarly affected. And so it's really a combination to build scale and to combine operations to survive in the long term.
I was just going to, Miriam, I was just going to connect the two things Paul said on this question and the prior one with Covenant Light. The one thing I'm always trying to tell in these situations is to try to keep it, keep it simple. Now, what Paul said is exactly. I mean, if we take back now for a number of years, the definition of EBITDA or normalized EBITDA is pretty solid now, especially across the private equity community. But we still see a lot of things where people are saying, well, that didn't happen last year, so we should normalize that and all that. So, but I think as Paul said, on the costs were there. But the consequence of that is relating back to the former question with regards to covenant setting. I've been involved in a couple of things where the covenant calculation got so complicated, right? Because people were trying to sort of, calculate different periods and compare them to prior years and whatnot. And in this case, the business had been extremely affected by COVID-19. Okay, and we're talking drops of 70 to 80% from the top line. And given the nature of the businesses, I'm not too sure when they will come back to something and what that new normal will be. So trying to set those covenants, and with regards to a revenue type factor, I would just confirm exactly what Paul said is we're getting, you get into really complicated things where you start to wonder if people are even understanding, what they're trying to measure here. So time will tell how this pans out. But my suggestion to everyone is always to try to make things a bit more simpler, at least in the short to medium term.
Yeah, and Miriam, the one thing I would add, in a normalized M&A environment pre-COVID, when you had uncertainty around an item that maybe you couldn't put a value to, we would advise our clients to price that into the deal, right? So you put a range, you say, well, what could the potential impact on EBITDA be of this item within a range? And then we would use that to, let's say, reduce purchase price and say, okay, we've gotten some level of comfort around that. Unfortunately, more recently, because of what I mentioned earlier on the scarcity factor, you can't price it into the deal because there's too much capital and there's too few deals to transact. So it's bidding up those prices, because if you don't pay for what they're telling you the add back for COVID-19 should be, somebody else is going to come in and do that and take that risk. Now, whether that's the right answer or not, that's for the investor to decide. But historically, our advice was always price it into the deal. You can't do that these days. Too much capital to deploy. People are bidding it up. Someone's going to pay for it, either you or somebody else. And that's where, the investors have to make the tough decisions, as to whether they want to take on that risk or not.
Yeah, we're seeing, slightly different point, but we were expecting that given the uncertainty, we'd see a return of the price adjustment clauses in European M&A, because as you know, in the US you tend to do price adjustment. In Europe we tend to do locked box, where the price is frozen, at a look back date before signing, and it seems we're just staying, the scarcity probably, but we're still just on the continuing with the lockbox and the attempts to pivot back to the price adjustment to take into account the impact of the net debt to the all the way to the closing has not been very successful so far. So it's it seems that again the crisis has not affected the pro-sale nature of the market on this point. What we are seeing a bit though is earnouts, because that's a way to, EBITDA for 220 isn't so good, but you're being promised that 21 will be incredible and 22 even more so. So, that's something which there's a bit more traction around. But not all deals are. And building earnouts in P deals with reinvestments of managers is often a challenge.
That's really fascinating. And it kind of touches on the next thing I want to ask you about, which is what has been the opportunity in distressed M&A, and is there actually a lot of distressed M&A happening, or is it really that companies are getting bid up because of the scarcity?
I'll start. I'm more of a distressed guy than a non-distressed guy. So I actually thought we would see more, to be very honest. That's just my personal opinion. And like as everyone here on the panel said, we're starting to see more deal activity. but I would have thought there would have been more distressed M&A. I'm not seeing that yet. It's maybe still to come, because I think everyone, while there is more confidence building and whatnot, there are, hopefully not, but there may be other instances of the pandemic coming back and whatnot, and who knows if businesses have adapted quick enough to be able to adapt if a second round were a strong second round were to come. So we do see some distressed M&A, but these are the businesses, once again, that were probably due to fail, Miriam, and then the fact is it's just been accelerated now. But I would have thought we would have seen more. That's how I see it.
Yeah, obviously we've seen. I'm sorry, Paul. We've seen a whole host of companies file for bankruptcy, and so maybe it's just a timing lag there as they work their way through those processes, and the M&A might pertaining to those situations might be later this year.
I think, Mary, to your question, it takes some time for the distress to set in. So, like I said, it's only been a few months, and you had a lot of capital in the system, a lot of liquidity to prop up these businesses. You had a lot of government stimulus that came in that also helped, right? So I think, in the short to medium term, you're not seeing as much distressed activity for those reasons. But I think as time goes on and, the government stimulus sort of runs out, and, people are not as willing to put liquidity back into troubled businesses that they see are not recovering as fast due to COVID. I think, if the pandemic continues to go on longer without a vaccine or a cure, that's going to cause a problem. And then I think finally, the biggest things that really drive this are twofold. Number one, unemployment. There's a tremendous amount of unemployment, and the benefits because of the government stimulus have kept people afloat. But it's not as easy to bring all these workforce right back into these businesses once they turn them on. We're seeing that now with our existing clients. That's one challenge. But the biggest thing that keeps businesses afloat is consumer spending, and consumer sentiment and consumer spending. And if you have a large unemployed workforce, the consumer spending has dropped tremendously. And I think without that, you're going to have more and more distress. Now, the obvious businesses that were impacted, whether it be retail and restaurants, things like that, those are directly impacted. But I think over time, for the reasons I just mentioned, you're going to see that spread to more industries that aren't the obvious ones, just as consumer spending and unemployment continue to drag, government stimulus runs out, and the pandemic continues to go on. So I think we could be in a situation, whether it be 6 to 9 months from now, where you have a continued uptick in restructuring, turnaround, and crisis management bankruptcy activity. At the same time, a run-up in M&A activity for the reasons we're all talking about on this phone. We could have both, which is unusual because usually you have one or the other, depending on the economic environment. We may have both going forward in 6 to 9 months, possibly.
Yeah, we're seeing that in France. We think it's creeping up, but it's slow because of the government support, which has been very strong here with all companies not only getting state loans but also delaying taxes, delaying social security, delaying the payment of commercial rents. But all this, is piling up. So there's a mountain of of working cap debt, which is piling, and which will be due before year end. Government said they may waive some of it, but they won't be able to waive it all, especially not for the larger companies. So we think it's, as it was said before on this panel, it's delayed, but it's coming. And we've actually geared up our distressed restructuring team here in Paris because we want to be ready when it hits. But probably we like others, we thought it would be quicker, but the government support was so broad that it's delayed the effects.
Mary, the other
chance of further government support? I mean, or is it over from your perspective?
Go ahead, Alexander.
No, it's clearly continuing, but at some point, when the company needs restructuring, there's only so much you can do. You can't pile up the cash forever. In France, we have a large aviation industry. I mean, there's going to be some restructuring there. It's because it's it's a structural change, and whatever amount of government money you put in, some restructuring is going to happen. But that's also opportunities for M&A, because starting with Airbus, but the valuations of the listed companies, at least in this sector, have more than halved. So we expect activity there, but it's slow because the diligence is very complicated, and obviously the forward looking is complex.
I was just going to say I agree with Alexander. I think there's still some, but it's obviously not a perpetual bank of money there. It will end at some point, and there will be choices that the governments will have to make. I think in certain instances that a first tranche of money was given, and in certain cases, I think that governments need to think about if they would put more money into that specific industry or not. But so there's a little bit there's also a political dimension to this whole thing about what industries to support and what not. And the one point I just wanted to address from earlier, Justin brought up a good point about Chapter 11 and whatnot. A lot of that also has to do, I'm sure more will come. A lot of that has to do also with the legal frameworks that are in the various countries, where Chapter 11 is completely an established process, and it is sort of the golden standard for structuring around the world. In the UK, you've seen a lot of companies go into administration because that is a very well developed tool, and that has led to a lot of potential M&A there. But as you sort of move east from the UK, it starts to slow down. But I agree with Alexander that that's probably a timing lag, and we will see more come, because that will be the tool that will need to be utilized.
Maybe we can turn a little bit to the process of due diligence and how that has changed in the wake of COVID-19. One of our audience members asks, has the process of due diligence become more, quote, diligent?
Yeah, well, I can start on that one. So I'll make 2 points on due diligence. So the way I always could measure what the market is, how long of a period of time we have to do due diligence that our clients give us. And it's very cyclical, similar to the market. If you go back and you look at, the dot-com bust in 2000, then you go to the financial crisis, now you go to COVID, you have a period where as the market of M&A accelerates and becomes more bullish, the period of time to do confirmatory due diligence shrinks. And, listen, there's levels of diligence, right? You can do verbal confirmations, or you could actually go back to source documentation. It's just how much time and access you have to management and books and records and things like that. But what happens is it tends to reset when there's a crisis, right? The quickest I've seen, ever, I would say, 10 days to do due diligence. And, you can only do so much in 10 days. And are those business days, weekends, like who knows, right? So then you'll have a crisis, and the diligence period will reset, and it'll all of a sudden go back to 90 days to do confirmatory diligence. And a lot of what drives the diligence timeframe is competition. Someone will say we could be done in 60 days and confirm our valuation. Someone will say 30 days. Next thing you know, someone's at 10 days, right? And it becomes a little bit, unrealistic. So number one, I would say, yes, it has gone back to more time to due diligence. So we've seen the typical reset, and it happens regularly over the years. The other thing I would say is, when it comes to diligence, the difference of doing it on site versus remote. Now, historically, a certain percentage of diligence has always been done on site, where you visit facilities, you sit with financial and operational management, look them in the eye, read the body language. And that's really the right way to do it, because there's no substitute for spending time with people. But in this environment, we get plenty of calls now. It's, hey, Paul, can you do all your diligence remotely? Because we're really not traveling still due to the lockdown. And the reality is we can. We do a lot of advanced data analytics, which helps. So I would say, the pandemic has driven the technological advancement of diligence, probably about 5 years from where it was. So we've really accelerated technology and data analytics. And as far as the work and the analysis, we can do that remotely without having to be on site. We're able to get the company's data, analyze it, but there's an element that's missing. And it's that intangible of spending time with people and physically visiting facilities. Now, we have clients who have transacted without actually visiting a company or meeting with management. But according to them, they have longstanding relationships with the management team. They've been following the company for years, so they're comfortable doing that. I've had other clients come to us and say, unequivocally, if we can't visit and spend the time, we are not doing the deal. So it seems to be, all over the map. But I would say those are the two big things. The timing tends to reset, in a crisis where you do more diligence, and then it ramps back up as things get busier. And the work being done remotely through technology and data analytics has been accelerated tremendously. That's what I say the two key factors that we're seeing on our end today.
Right. No, I agree, Paul. And you are seeing things that we traditionally haven't seen in the past. Obviously, broader use of video chats like this one, maybe more so even in the first round processes when you're not going to have an in-person management presentation. The second round might be more open to having conversations with the management team so they can present the opportunity to prospective buyers on a video conference. Looking forward to some of the assets that might come to market. Sellers are trying to just make sure that they have a complete package. So whether that's enhanced VDD, whether if you're talking industrials, you have drone footage of facilities. A lot of these things are just something that we haven't seen in the past, and all this goes back to the inability potentially for the bidders to have that on-site experience. And I would say that the winners in this game are going to be the bigger companies, because if you are buying a company that is the revenue would constitute a 50% increase pro forma to business, then you're not going to be as aggressive if you're not able to meet the business or have on-site due diligence. So the larger corporates who have business development teams in various countries will be able to move faster, and then obviously just from a relative deal size, be able to evaluate opportunities and absorb them quicker than the smaller players.
I was just going to add 2 points on to what the panelists have said so far. One, I'm doing one right now where we're doing a virtual tour, literally with in a country at a manufacturing plant at a country in Asia, where they're walking around with a webcam or a GoPro or something like that and looking through the facility. And so it's a different type of experience. I think when you talk about manufacturing and whatnot, it's one thing to see an empty plant, at least you get a bit of the layout and stuff, but if you don't see it in operation, it really, from my perspective, takes away from really understanding the dynamics of a industrial type company. So I think that's one point that we'll just have to see how it plays out. Factories are starting up again, so that is helping that. The second point, from the financial crisis, the one thing I learned, I think, was when people were doing diligence. Of course, you do your sensitivity analysis and whatnot on if revenues fall by this much, here's what the effect is. But no one was sort of doing what I refer to as the disaster scenario, and rightly so. Even though they'd seen the dot-com crisis in 2000, but no one was saying, well, what happens if the top line drops by 70%? What do I do? What are the actions I can take? What can I do to safeguard the business? I wonder if that's going to go forward now, if some people will now, in their diligence, go through the regular nuts and bolts like we always do, but also make sure that there's something there and a little bit of contingency planning. Obviously not in the initial phase of diligence, but as you get forward through to confirmatory diligence and whatnot, is to start to think about some of those types of factors. I would hope that would be the case, and that would I think make a big step forward.
Maybe two additions to what the panelists have said. I mean, very short. What we've been advising when we're advising a seller is to preempt the COVID questions. So we put together, a VDD weathering COVID report to really preempt these questions and provide reassurance as quickly as we can before the questions are not answered properly. And the other is the trend to obviously going to virtual management sessions. We as lawyers we appreciated the fact that we can get back into the management sessions, because often you don't want to outnumber the management by coming with all your advisors. So we just get the tough bit of going through the myriad of documents in the virtual data room. Now through these Zoom presentations, it's much easier to get the advisors back into the management sessions, and really improves the work we can do when we've actually heard management provide the voiceover to the documents we're reviewing. So I think there's a good aspect of this not in-person form of diligence we're seeing.
So maybe some good changes that are here to stay for due diligence. Here's an interesting question from the crowd. How does the situation that we're seeing now impact operational value creation strategies for portfolio companies? Maybe Bob is a good person to answer this one.
Yeah, I mean, thanks, Miriam. I'll kick off. I mean, first of all, the hurdle rates now are going to be more challenging. Okay, so we know with a lot of our private equity clients on building the value creation, we like to come with what are realistic things, but also challenges. And typically a lot of PE clients come and push back and say, how come they can't do more and what's not? And so I think now those hurdles. I mean, the deals will happen. The hurdles to get through will be more difficult. And it will take a lot more heavy lifting to be able to implement those types of value creation strategies, to be able to generate those types of multiples and returns that PEs are used to seeing, and what they strive for with regards to their fund structure and how quickly they like to turn over a business. So I think the other point also is, typically if you look at the life cycle of PE, buying, harvesting, and then exiting, we've seen things from 3 to 5 years quite typically. I think now to be able to get those types of returns, a little bit of the unknown, and being able to maybe transform the business model that a lot of these companies are going to need to do, it's going to be a longer time period, and maybe the returns are not going to be as great as one would have expected. So it'll still happen, but I think everyone needs to probably set the bar a little bit lower.
Right, I agree. I think you can't put too much reliance on these first couple of years. Right? You have to think more of a long-term play. So it's the opportunities and the buy and quickly flip the sponsor plays that we've seen in the past might not be something that is feasible. But who knows, right? I mean, nobody knows what 2022 holds. So I think that you just have to make sure that you really have an understanding of the underlying business, the overall industry trends, get comfortable, and your capabilities to not only grow the top line, but also come in and help operational performance. But then also, instead of 3 to 5 years, maybe you're looking 5 to 7 years, and maybe if you're not looking at a 30% return, maybe you're getting some comfortable something in the low 20s.
Does anyone else have anything to add on that question? We only have 3 minutes left.
Miriam, I'll just maybe add one other point.
Yeah.
Sorry, I thought about this as Justin was saying something. I think also in how will that value creation change? I think usually there used to be a lot of these quick wins and whatnot as you first get in there. I don't know how many of those there will be now, right? So I think you're going to have to start thinking a little bit more strategically, and also taking into account travel restrictions. So one thing I would be looking at in a lot more detail that maybe I wasn't doing so much before is supply chain, for example, right? Because are you going to be getting goods from Asia coming through, and what is the impact of that, and how long does it take, and is there a much more stronger security process to bring stuff in, from different regions and whatnot. So I supply chain would be something that I would probably spend even more time than we were probably spending with clients, and I would push that sort of that type of framework and see where that would go.
That's great. Todd, is now when I should turn it back over to you. I don't want to ask another question if we don't have too much time left.
I just want to say, clearly we have more questions, than we have time to answer, but we do want to be respectful of people's times. If you have further questions for our panelists, please be sure to reach out to your local EACC chapter. We can easily connect you to any or all of the panelists. But as I said, we do want to bring this to a close. I want to say thank you so much to our presenters, Paul Aversano, Alexander Crothwaite, Justin McGrory, and Bob Rajan for sharing your experience and your insight. I want to thank especially to Miriam Gottfried for her excellent skills in moderating this exchange. And most importantly, thanks to all of you for joining us for today's discussion. Just a reminder, all comments and opinions presented by our speakers today represent their own views. They do not necessarily represent the views of the European American Chamber of Commerce or its members. We would encourage you to stay in touch with your local chapter of the EACC for information on upcoming webinars and events. And if you wanted to recap any of the details or share this with a friend, note that a video of this recording will be posted on our YouTube channel in the very near future. Thanks again for joining us. Thanks to our panelists. Farewell.
Farewell.